when you take more risk, you need to maintain higher capital. And capital requirement for low risk business will be, what will be the actual profit? Your cost of that risk, we are not accounting anywhere, has to be factored, then only you will get risk in a business or investment is netted against a return from it. We have been discussing about the capital, requirement of capital and its linkage between the return and risk. So, whenever we talk about the risk, we need to mention capital. Whenever we mention capital, it affects our profit. That is the linkage between risk, capital and return. It is also called the trinities of risk management. So, we assess the risk, identify the risk, assess and measure the risk, then you price it, monitor and control and mitigate. In this process, what is the purpose of measurement of risk is to assess what is the quantity of capital to be required to be maintained. That is the minimum capital required. When you want to get more profit, you have to take higher risk. When you take higher risk, you need to maintain higher capital also. So, it will have an impact on return. So, whenever you want to keep more capital, you have to incur a cost. That cost will affect your profit. That's the linkage between capital, return and risk. So, capital, before starting any business, one has to protect himself from losses if any happen. That is, the uncertainty has to be attended. Then by infusing own fund for having the cushion. That's the cushion. So, that what is cushion? It is the cushion is required to absorb any losses, loss absorption function or backup support, which risk management is called as capital. So, in risk management, maintenance of that cushion to absorb the loss or backup support is called capital. So, capital is the basic requirement. Whenever you assess and quantify the risk, you need to maintain capital. Minimum capital required for a business should be such that it is able to meet the maximum loss. That is what is called cushion. Maximum loss that may rise from the business such that the bankruptcy can be avoided. So, bankruptcy is avoided by way of maintaining adequate capital. So, it can be concluded that capital requirement for high risk business will be higher. Why? Because high risk business, when you take high risk business, your risk weighted asset will be more. You need to maintain more capital. High risk means risk is more. You need to maintain a cushion. You need to have enough adequate buffer with you. That buffer is called capital. So, when you take more risk, you need to maintain higher capital. And capital requirement for low risk business will be, of course, it will be ulta in the other way. So, low risk business will be lower. This is the basic linkage between risk and capital. So, that is the linkage. So, whenever you take more risk, higher risk, you need to maintain higher capital. Whenever you take low risk, you need to maintain lower capital. This is the linkage between risk and capital. Now, let us see the linkage between risk and return. Return is with regard to the profit or loss. So, what we discussed in the previous sessions, so expected loss, we need to calculate the expected loss. In addition to maintenance of regulatory capital, you need to assess and quantify the risk which you are taking in your books of account. That risk has to be quantified, that loss has to be assessed, and equivalent to that loss you need to keep capital. So, that is called, that provision calculation is called the expected loss calculation. We discussed in the previous session. Expected loss has to be calculated. So, expected loss, how do you calculate? You have to calculate, yesterday we discussed, PD, probability of default, into exposure at default, EAD, into LGD. Loss given default. Probability of default, exposure at default, loss given default. It will give you, so multiply these three things together, you will get expected loss. This has to be reduced from your profit. this expected loss has to be reduced from your profit. So profit will come down to the extent of this expected loss. So that means expected loss has to be reduced from the profit, and you take that portion of the profit to the provision in the balance sheet. That will act as a cushion or buffer. It's a part of capital. So that is the expected loss. So in this process, what will happen ultimately? So in this process, expected loss you are calculating, you are arriving at a certain quantity of loss. Then you find out that you have this much amount of volume of net profit. You are reducing from the net profit. That means your profit will come down. That means whenever you take higher risk, you have to quantify that expected loss. You have to reduce it from the profit. In that process, your profit will get affected. That is what it is stated here. Now, let us see the linkage between risk and return. This is the linkage between risk and return. What is the linkage? Higher risk expected loss will reduce your profit. Reduce profit. So that is the linkage. That means higher higher return, higher risk means lower profit. So it will affect your profit. Of course, when you take, there is a chance of getting more profit also, return also. But when you quantify the risk and keeping adequate capital, it will affect your profit also. Both way it can happen. That's the linkage between risk and return. What is the linkage between risk and capital? You take higher risk, you keep higher profit. Higher capital. So higher risk means higher capital. Higher risk and return and risk and return. What is the linkage? Higher risk means profit can either go up or come down. Come down in what situation? When you quantify the risk as expected loss, when you reduce it from the net profit, it will affect your profit. It will come down. And when you take higher risk, there is a chance of shooting up a profit, higher profit also. So the return will be more in such cases. So in both way, it can happen. So high risk business, either higher profit or higher losses. Low risk business, either lower profit or lower losses. So this is the linkage between risk, return and capital, also called trinities of risk management. As can be seen from the previous table, when we compare three investment, you remember the three investment we compared? Three investment, return 1, return 2, investment 1, investment 2, investment 3, like that. The first investment we were getting 500 and the cash flows were steady. So every year we got 100, 5 years we got 500 as the net return, the net cash inflow, net inflow. Then the second investment we were talking about the same kind of investment, but the cash flow were fluctuating. So there were wide fluctuations in the cash flow, but still it ended up with the same profit of 500. You remember the third investment we have been discussing? In the third investment, the risk was higher. But so for that, taking a risk exposure, higher risk exposure, that investor got higher money. So 540 he got it from the example which we discussed. So 540. So when he was ready to take higher exposure, higher risk, he got a higher percentage of return. It was called a risk premium. So that is what it is discussed here. Low risk premiums, either lower profit or lower business. So when we compare that three investment options, comparing the return on investment may not lead us to a correct conclusion. See the investment 1, see the investment year 1, year 2, year 3, year 4, year 5. See here what we have discussed is year 1, 2, 3, 4, 5. Investment 1, investment 1, investment 2, investment 3. So here 100, you got 100, 100, 100, 100, 100. So the total will be 500 you got. So here we were comparing the return of investment in each investment, comparing only the net profit we derived. the net cash flow which we got as income, that only we were discussing. Here also 100, then 120, then 90, then loss 30, like that it was going. Then the third one we was getting 150, then 30 minus, then 210 like that, then minus 20, then minus like that it was going on. So he got the same 500 here, here he got a 540. So this example we have been discussing earlier. So in this investment, 500, 500 and 500, these three, we were comparing only the profit portion. Profit. That is the net profit. We were not factoring any other expenses or risk factor into this calculation. We were comparing the net profit which we derived from this investment, and were comparing and taking a decision based on the net profit generated. But exactly, is it the good way to calculate or arrive at an investment decision? No. We have to factor something more, because we are incurring a loss. We are facing some default, or we are facing some risk. We are anticipating a risk component. We are factoring a risk component into pricing also. So many things are there we have to consider in between. So where will we compensate this kind of risk which we are taking? Of course, we are compensating it by way of adding or factoring it into the pricing component. And also, when you factor this thing, where will it get affected? So this impact will be on which portion in your books of accounts. So the impact will be, of course, in your P&L account, because it will affect your net profit. So what will be the actual profit? Your cost of that risk, we are not accounting anywhere, has to be factored. Then only you will get a clear picture, exact picture. What exactly has come out from the business? You are factoring all the expenses, the risk factor also to be factored, and you have to reduce that cost of risk from your net profit. Then only you will get a risk adjusted return. That is called RARI, risk adjusted return on investment, or risk adjusted return on capital. So that will tell you the exact profit. Even after accounting the risk factor, you have come out with a certain percentage of risk adjusted return, which is the actual return recorded by the business. Without disclosing that factor, you cannot come to a conclusion that this unit has derived this much profit, unless this risk factor is factored. So that is the importance of risk adjusted return on capital. So that's the key topic which we will be discussing repeatedly in the credit risk classes. As can be seen from the previous table, when we compare three investment options, comparing the return on investment may not lead us to a correct conclusion, as risk associated with these investments may differ. So investment 1 risk may be 10%, investment 2 risk may be 20%, investment 3 risk may be 30%. So you have to, depending upon the risk factor, the quantity of risk, the quantum of risk, you have to arrive at the risk component and deduct it from the profit. Then only you will get the exact picture. So it is better always to factor this risk component into your net profit. You reduce it from the net profit, then you arrive at the net return after adjusting the risk component. That is the risk adjusted return. It will give you a true picture of what exactly the business has generated as profit. Then only the investor will get a clear idea, okay, this institution or this particular unit has come out with this much profit even after factoring the risk of this much. That will give you a sound financial position. He will come to know that this financial position of this particular institution is very sound. I can easily, very well go for investing something into this institution. It will give the investor a sense of confidence. That is what the RAROC gives. So the return on investment may not lead us to a correct conclusion, as risk associated with investments may differ. So it would be desirable to account for risk. That is what is important. You have to account for risk. From where you will account for risk? Account for risk means you will reduce from net profit. Net profit minus that risk cost, RC. This is also called expected loss. That is the risk component, expected loss. This will give you the risk adjusted return. Risk adjusted return. Then only it will give you a correct picture of what exactly the profit is. So returns of risk would be the proper basis. Return after risk would be the proper basis of comparing investment. Then you compare. You find out what is the risk involved in that investment. You reduce it from that 100 rupee every year. We were discussing about 100 rupee generated cash flow. So from that 100 rupee, if 40 rupees the risk cost, you reduce the 40 rupee cost, then you arrive at the net profit as risk adjusted profit as 60. So 100 rupee is the, or 500 is the total income generated in investment one. 500 is the income generated. What is the cost of risk or expected loss? Expected loss is equal to 40. Suppose we have calculated expected loss as 40. Then what is the risk adjusted return? RAR will be 460. So it is nothing but net of expected loss. The net profit reduce expected loss, you will get risk adjusted return. So risk would be the adjusted risk would be the proper basis of comparing investment. In other words, risk in a business or investment is netted against a return from it. So net profit minus risk will give you the adjusted return. This is called a risk adjusted return on investment. Risk adjusted return on investment. That is net profit minus expected loss will give you the risk adjusted return on investment, or risk adjusted return on capital. It is also called a risk adjusted return on capital. There is a formula to calculate risk adjusted return on capital. We will see. So RAROC. This is one of the major topics in your syllabus. RAROC calculation. What is the linkage between risk return on capital, and how do you calculate the RAROC? What is the purpose? What is the meaning of calculation of RAROC? So what it tells, what is the implication? So why the banks always give to publish, to calculate, arrive at the RAROC and disclose? Because the investor will come to know that what is the financial position of that company, how much is their risk they have adjusted, how much is the net profit even after adjusting the risk, whether they have come out with a sufficient quantity percentage of risk adjusted return. If the risk adjusted return is more, it will tell that the financial stability, the strength of that financial institution is good. It has a sound liquidity or stable funding position is there. So that is what is called RAROC, risk adjusted return on investment, or risk adjusted return on capital. RAROC. So this risk factor, which is netted out from the return, is called the expected loss. This is more important. That is what we have discussed out. EL, expected loss. It is nothing but what this is the cost of risk. Cost of risk. Expected loss is the cost of risk which has to be netted out from the net profit, will give you the risk adjusted return. Simple. RAROC calculation. Formula for expected loss. This is the formula you have to by heart. How to calculate expected loss. Calculation of expected loss is using this formula. Expected loss is equal to probability of default into loss given default into exposure at default. Probability of default, loss given default, exposure at default. How to calculate probability of default, how to calculate loss given default, how to calculate EAD, we will discuss in the coming sessions. So, the formula you have to by heart to calculate expected loss, PD, LGD, EAD we use. Probability of default, what is the percentage of probability of default? What is the loss given default? That means what is the unsecured portion? What is the exposure? Nothing but the exposure in your books of account. So, multiply these three things, you will get the expected loss. You reduce it from the net profit, you will get RAROC. Expected loss, you reduce, you will get RAROC. That's it. See one example. Particulars, income, expenses, profit, expected loss, RAROC. This table shows that. Next row is amount. Then the details, particulars. Suppose income from business. What is the income from business? From the basic banking transactions. What are all the basic banking transactions which we do in the normal banking? Acceptance of deposit and lending money as loans and advances, or investing in the other securities in the market or whatever it is. Okay. So, that is what the bank, every bank does. So, in that process, what you will get? You will get income by way of, mostly by way of interest. So, in the banking book of accounts, your income is from mostly from the major portion of chunk of income is from your loans and advances. So, income. Sometimes the income, it will not be given directly. Sometimes they will say that instead of giving direct, this is, suppose you consider this as a case study. Okay, this case study is there. You will be asked to find out, arrive at the RAROI, risk adjusted return on capital. So, in the question up to this portion will be there. Then you will be asked to find out RAROC. So, what are the things here? It is available here. Income is stated here. Expense is here. So, income minus expenses, of course, you will get profit. Profit is also there. So, 10,000 is the income, 8,000 is the expenses, 2,000 is the profit. 10,000 minus 2,000, profit is 2,000. 10,000 minus 8,000. What is the expected loss? In the question itself, they are saying that instead of calculating using the formula PD into EAD into LGD, they have straight away, they have given in your question that your expected loss is 500. That is the year. So, then what is the risk adjusted return? Profit 2,000, risk cost, that is the expected loss 500. So, RAROC 2,000 minus 500. So, 1,500 is the risk adjusted return on investment. This is the risk adjusted return. How do you calculate risk adjusted return? From this he can arrive at the formula. So, risk adjusted return, RARO, risk adjusted return on investment is equal to net profit minus expected loss will give you the risk adjusted return on investment. So, net profit, along with this net profit, you can add another thing that it has to return on capital, if any. Sometimes in the question they will give you another factor that risk adjusted return on capital will be this much. If it is given like that, you have to add return on capital along with the net profit. Then you take the net position, then you reduce the expected loss, you will get risk adjusted return on investment. So, risk adjusted return on investment, again repeatedly I am telling, it is the net of expected loss. you reduce the expected loss from the net profit, you will get the risk adjusted return on investment. So now you have to calculate what is the risk adjusted return on capital. So there is a formula. RAROC determines the return on investment by adjusting all the associated risks. What does it mean? All the associated risk means expected loss. You are taking into account the probability of default. You are taking into account the exposure at default. You are taking into account the loss given default. All these things are taken care of. All the risk factors are taken care of. You have calculated the expected loss. Then you have adjusted all the associated risk. You have adjusted all the associated risk. That is the expected loss. Then you have netted out. So RAROC, risk adjusted return on capital, determines the return on investment by adjusting all the associated risk. It expresses risk adjusted return as a percentage of economic capital. So economic capital, how much economic capital? Economic capital means whatever the capital you are maintaining corresponding to your risk, volume of risk. So against the risk as a buffer, as a cushion, you are maintaining capital. That is called the economic capital. Then what is regulatory capital? The regulator says that minimum you have to maintain this much of capital. So over and above whatever you can assess, you have to assess your risk component, your risk exposure. According to that, you keep capital. Whatever that capital is called economic capital. So for that economic capital, you have to calculate for the purpose of calculation of RAROC. So it expresses risk adjusted returns as a percentage of economic capital. The risk adjusted return on capital is calculated as follows. There is a formula for that. Risk adjusted return on capital, RAROC, is equal to revenues. That is what is called revenue income. So RAROC is equal to risk adjusted return on capital is equal to all the revenues. Revenues, that is income. Revenues minus all the expenses. Revenues minus all the expenses. Expenses plus return on capital, if any. That is also an income. Other than this loan income, interest income, other income also has to be taken care of. That income includes return on capital. Return on capital, if anything is mentioned in your case study, you have to include that also. So this minus expected loss. Expected loss will give you what? Your risk adjusted return on investment. Risk adjusted return on investment. That is the formula which says this risk adjusted return on investment, RAROI. This is RAROI, you got calculating revenue minus expenses plus return on capital minus expected loss will give you the risk adjusted return. This divided by economic capital into 100 will give you the RAROC in percentage. Simple. RAROI divided by economic capital into 100 will give you the risk adjusted return on capital. This formula you have to by heart. 80% chance is there you will get a question from this RAROC calculation. So many things, it can be in different forms, It cannot be a direct question, it can be in the indirect questions, way of asking questions. So RAROC, the formula is risk adjusted return divided by economic capital into 100. This formula you need to by heart.